Good. So once again, let me repeat the title of today's topic number 6, reporting liabilities and owner's equity. Let's start with the definition and classification of liabilities. As usually we do, first we watch video, and after that we discuss the main moments of these videos.
A liability is the probable future sacrifice of economic benefits that arise from a past transaction. For example, let's assume you were skateboarding last week and broke your arm. A few weeks later, you received the bill from the hospital. Those services happened as a result of your fall. You are now obligated to pay any amount not covered by insurance. When a liability is first recorded, it is measured in terms of its current cash equivalent, which is the cash amount a creditor would accept to settle the liability immediately. There are two types of liabilities. Current liabilities are expected to be paid with current assets within the current operating cycle of the business or within 1 year of the balance sheet date, whichever is longer. Non-current liabilities include all other liabilities.
So what is important to understand from these short videos that liabilities, this is the nominal value of cash that should be paid immediately. Immediately, it means in a short period, So this is the key moment. And the second about classification. For the reporting purposes, liabilities can be classified, not must. It depends on the intention of the business, can be classified into two main groups, current liabilities and non-current liabilities. So current liabilities are those which are expected to be paid within the current operating cycle. So this is important that we should cover current liabilities by current assets or within 1 year. So it depends on the duration of operating cycle. But what is important that current liabilities always paid with the current operating cycle, and it means that by current assets. Now, in more detail about current liabilities. So dear students, I'm sorry for this break. The system does not work stable today, so it could be some problems. But let me upload the presentation once again. So let's continue with the deferred revenue. This is one of the typical items in current liabilities, because in everyday operations it's normal to make prepayments, and if the customer makes a prepayment to the supplier should recognize this prepayment as deferred revenue. And the question is how to treat this deferred revenue in accounting.
In most business transactions, cash is paid when a product or service is delivered or soon thereafter. In some cases, however, cash is paid in advance of delivery. When a company collects cash before the related revenue has been earned, a liability called deferred revenue must be created. Let's assume that the hockey stadium in your town sold $2 million worth of season tickets relating to the team's 40 home games. The entry to record the advanced sales includes a debit to cash for $2 million and a credit to deferred revenue for $2 million. As each hockey game is played at home, season ticket revenue of $50,000 is earned. An adjusting entry will be recorded with a debit to deferred revenue for $50,000 and a credit to season ticket revenue for $50,000.
So this is the treatment which just recognize revenue and decrease deferred revenue prepayment. Next type of current liabilities, which we discuss many times and use many times in our accounting entries, and you ask me questions about this type of liability, is notes payable. Let's watch this video to understand the logic and the full description of this type of liability.
Banks and other creditors are willing to lend cash because they will earn interest in return. Earning interest by loaning money to others reflects the time value of money. To the borrower, interest reflects the cost of using someone else's money and is therefore an expense. When a company borrows money, it normally signs a formal written contract with a bank and reports the amount borrowed as a note payable. The note specifies the amount borrowed, the date by which it must be repaid, and the interest rate associated with the borrowing. Let's assume that Janssen Incorporated has a December 31st year end. On December 1st, year one, Janssen Incorporated borrows $200,000 from National Bank for 1 year. The annual interest rate is 6%. The interest is payable on May 31st and November 30th of the following year. The principal is payable at the maturity date, November 30th, year 2. The entry to record this transaction includes a debit to cash for $200,000 and a credit to notes payable for $200,000. Janssen borrowed the money on December 1st, so it must record 1 month of interest expense on December 31st, the end of its fiscal year. It does not matter that the company will not actually pay the bank cash for interest until May 31st of next year. The interest incurred for the month of December and the associated liability equals the principal of $200,000 times the annual interest rate of 6% times 1 month divided by 12 months, or $1,000. The entry to record interest expense and interest payable for that 1 month includes a debit to interest expense and a credit to interest payable for $1,000. On May 31st of year 2, the company has incurred an additional 5 months of interest expense for the period January through May. The interest incurred for those 5 months and the associated liability equals the principal of $200,000 times the annual interest rate of 6% times 5 months divided by 12 months, or $5,000. The entry to record this expense and the associated liability includes a debit to interest expense and a credit to interest payable for $5,000. Also, on May 31st, the company pays the bank $6,000 cash for 6 months of interest. The cash payment consists of the $1,000 of interest owed for December year 1, plus the $5,000 of interest owed for January through May year 2. The journal entry to record this payment includes a debit to interest payable and a credit to cash for $6,000.
So, dear students, very good video. I can say that is more technical. Everything is explained on the case. But what is the main conclusion? What is the summary? When you treat interest, you should compare interest expenses in accordance with the time. So if there is the whole period of borrowing, we should recognize interest expense based on time period approach. So divide all expenses into the periods and recognize in the moment of preparing financial statements. So this is about treatment of notes. And also let me try to open contingent liabilities. So maybe we can find them. So now for contingent liabilities, it is also connection error. It is also connection error. And let me see. Well, right now, let me open the presentation, and I also would like to add these videos with some also questions and issues. So let me open the presentation. So today this presentation will be available in the system. So first of all, current liabilities. Once again, I would like to comment the classification. So we can classify current liabilities not only for the purpose of the balance sheet, current or non-current, but also we can use the following titles. For example, accounts payable, we can also call as a trade accounts payable. And this is the obligation to pay for goods and services used in the basic operating activities of the business. The same situation with accrued liabilities. We also can call accrued liabilities as accrued expenses. And what is important, that this is obligation related to expenses that have been incurred but have not been paid at the end of the accounting period. So this is the difference between accounts payable and accrued expenses. Notes we already discussed, and deferred or unearned revenue we also already discussed. So notes payable we also discussed. Well, deferred revenues we also discussed. So about estimated liabilities, or contingent liabilities. There is a special type of liabilities which we call as a contingent. This is potential liabilities that are created as a result of the past events. And the probabilities of occurrence of these liabilities, of these potential liabilities, can be classified into three categories: probable liabilities, reasonably possible, and remote liabilities. Here on the slide, you can see the definition. The chance that the future event or events will occur is high. So this is the highest level of probability. Reasonably possible, very interesting definition. The chance that the future events or event will occur is more than remote but less than likely. So this is the lower level of probability. And remote, the chance that the future events will occur is slight. So this is the classification of contingent liabilities. Dear students, right now in this basic course, it's enough to understand the definition of these estimated liabilities. And at the advanced level, we also discuss in another intermediate accounting courses, we discuss estimated liabilities in more detail. Well, now let me return back to the platform, and I will try to open next material, which is devoted to the characteristic of owner's equity. And now we discuss the form of business as corporations. And let's start with the characteristics of corporation. So let me share with you again the screen.
As a stockholder, you receive shares of stock that you subsequently can sell on established stock exchanges. Owners of common stock receive a number of other benefits. Unlike creditors, you may vote in the stockholders' meeting on major issues concerning management of the corporation. If a company pays dividends, you receive a proportional share of the distribution of profits. You will receive a proportional share of the distribution of remaining assets upon the liquidation of the company. The corporate charter specifies the authorized number of shares, that is, the maximum number of shares the corporation is authorized to sell to the public. Shares that have been sold to the public are called issued shares. For a number of reasons, a company might want to buy back shares that have already been sold to the public. Shares that have been bought back are called treasury stock. Shares held as treasury stock are considered issued shares, but not outstanding shares.
So dear students, very short video, but very important in terms of definition. So first of all, we discuss the corporation ownership and the main characteristic that corporations issue shares. And there are several types of shares. First of all, authorized shares, the maximum amount of shares. Then we have issued capital, which contains two possible types of shares: outstanding shares as a difference of issued shares and treasury shares. So this is what we should understand in classification. So today a lot of technical problems. I don't know what is going on, but it's really not good. Well, let me upload. Let me open once again. Okay, so let's continue and discuss in detail treasury stock. Treasury stock.
Stock that has been repurchased and is held by the issuing corporation is called treasury stock. Treasury shares have no voting, dividend, or other stockholder rights while they are held as treasury stock. When companies repurchase shares from the market, they pay cash and receive their own stock. Let's assume that Public Stores Incorporated repurchased 100,000 shares of its stock in the open market when it was selling for $20 per share. The journal entry to record the repurchase would include a debit to treasury stock and a credit to cash for $2 million, or 100,000 shares times $20 per share. The treasury stock account is not an asset account because a company cannot own itself. Instead, it is a contra equity account, and as such, it is reported as a negative number in the stockholders' equity section on its balance sheet. When a company sells its treasury stock, it does not report an accounting profit or loss on the transaction, even if it sells the stock for more or less than it originally cost to repurchase the shares. GAAP does not permit a corporation to report income or losses from investments in its own stock because transactions with the owners are not considered normal profit-making activities. Let's assume that Public Stores Incorporated resold 10,000 shares of treasury stock for $30 per share. Recall that the stock was purchased for $20 per share. The journal entry to record the resale would include a debit to cash for $300,000, or 10,000 shares times $30 per share, a credit to treasury stock for $200,000, or 10,000 shares times cost of $20 per share, and a credit to additional paid-in capital for $100,000, or 10,000 shares times the difference between the resale price of $30 per share and the cost of $20 per share. What if the treasury stock had been resold at less than cost? Let's assume instead that Public Stores Incorporated resold the 10,000 shares of treasury stock for $15 per share. Again, recall that the stock was purchased for $20 per share. The journal entry to record the resale would include a debit to cash for $150,000, or 10,000 shares times $15 per share, a debit to additional paid-in capital for $50,000, or 10,000 shares times the difference between the resale price of $15 per share and the cost of $20 per share, and a credit to treasury stock for $200,000, or 10,000 shares times cost of $20 per share.
So, dear students, this is some technical questions concerning accounting treatment and preparing accounting entries. But I would like to focus your attention first of all about the characteristic of the treasury shares. Maybe I can open.
Stock that has been times the difference between the resale price of $30 or 10,000 shares times 1,000 shares of transactions with the owners are not considered.
So I would like to repeat once again the main characteristic of treasury stock. First of all, this is the shares that have been repurchased and are held by the issuing corporation. So no voting rights, no dividends, no other stockholders' rights. This is the characteristic. And this is the contra equity account that reduces stockholders' equity. So we should put treasury stock to the owner's equity section with minus to subtract the overall amount. And of course, no gain or loss reported, because treasury stock is not a question of making profit and business outside the company. So this is the main characteristic of treasury stock. Good, good, good. So as I understand, we cannot open sale of common stock. Let me try again. So, but no, it does not work. Okay, so I will comment by the right. Yes, this is a connection error. Okay, no problem. So I will explain you based on the presentation. So once we discuss the dividends on common stock, if it's also possible to open dividends on common stock. So I'm sorry for today. I don't know why it's a really great technical problem to connect to the platform. So. I think maybe it's easier. I will open the presentation and comment to you the main issues concerning owner's equity, because I'm a little bit tired to upload without any success. So let me just change this. Okay, good. So let me continue with the with my presentation. So common stock transactions. Common stock transaction. We already discussed treasury stock. Let's discuss common stock transactions. So once again, there are two primary sources of common of stockholders of equity. We discussed this moment from the first topic up to the sixth topic. We have two main items: contributed capital and retained earnings. Contributed capital contains two components as well: common stock or share capital with the par value or nominal value, and capital in excess of par value, which we always call as additional paid-in capital. And as a result, we normally have at least three items: common stock or ordinary shares, capital in excess or additional paid-in capital, and retained earnings. So what is the basic characteristic of the par value? So it should be two possible characteristic about par value. So first of all, this is the nominal value and legal capital. So the legal capital is the amount of capital required by the law that must remain invested in the business. So it's also important when you register a company, you should meet legal requirements for the capital. This is what we call legal capital. So this is the minimum of capital which is required by law for the business. So, and for each type of business, it is always in every country there are some limitations and requirements. What is important that when we consider common stock transactions, we should understand that in market economy, par value is not equal to market value. And of course, this is why we have this surplus or maybe deficit. So when we call as a paid-in capital. So, when we recognize the issuance of ordinary shares, we should consider two accounts. First one, common stock, when we make the records concerning the nominal value or par value, and also capital in excess or additional paid-in capital in correspondence with cash. So this is how we should treat issuance of stock. This is not new material. We already discussed it, but once again, let me repeat. So this is about issuance of common stock. The repurchase of stock, which we already discussed. This is about preferred stock. And the question about dividends, how to recognize, how to make records about dividends on common stock. First of all, main characteristic: dividends on common stock declared by board of directors and are not legally required. So this is the decision of the board of directors at the end or after the end of accounting period to distribute the net income between owners of the business and the company itself. The declaration of dividends creates liability at the date of declaration. And also we should understand that in order to pay dividends, company must have sufficient retained earnings and cash. So let's consider several important dates concerning dividends. First one is the declaration date, where, the date when board of directors declares the dividend. In this moment, the liability should be recognized. You see dividends payable as an increase in dividends payable on credit. And in the same moment, we should decrease net income. But normally, the declaration of dividends is on the date after reporting date. And after reporting date, all net income is close to retained earnings. This is why we should subtract retained earnings in order to pay dividends, because net income is already in retained earnings. This is why in correspondence you see retained earnings account, retained earnings account. Please pay attention for this accounting entry. And another day, important day, this is the date of payment when the dividends are paid, and accounting entries are the following, just to decrease cash. Of course, it's obviously to decrease cash when we pay, and also to decrease a liability for these dividends. To decrease dividends payable, you see dividends payable are on debit, Maybe one moment concerning stock dividends. So sometimes companies cannot pay dividends by cash, but instead of cash, the company can pay dividends by stock. So this is the distribution of additional shares of stock to owners. And as a result, there is no change in total stockholders' equity, no change in par value, and all stockholders retain same percentage ownership. The only change is between common stock and retained earnings. Let's discuss this case. Assume that the company issued a large stock dividend. The company issued 400 million shares of its $1 per value stock. And the journal entry is the following. We should recognize increase in common stock, you see, on credit. But how? Just to decrease retained earnings. So this is the reclassification in the right part of the main accounting equation. So as a result, you see no change in total stockholders' equity. The only change is between balances of two specific accounts, of two special accounts, retained earnings and common stock. That's all. This is the structure of this transaction. So, dear students, I can say this is briefly the material concerning liabilities and owner's equity. I would like to repeat that we already discussed this material, I mean, in main aspects, maybe excluding the classification of shares in the previous topics. So the new material today is the classification of dividends, the treatment of treasury shares, and maybe that's all. So I cannot see any more new material. So we don't discuss in our course long-term liabilities and the concept of net present value. This is the material for intermediate course. If you choose accounting on the upper years of your studies, we meet again and we discuss these questions in more detail. So right now, let me try to repeat some material, and I would like to start from the very beginning, and to open the first video of balance sheet. We should repeat balance sheet. Just a moment. Balance sheet. So, dear students, as I understand, today we have some technical problems with the platform McGraw-Hill Connect. So what I suggest to do, I just open presentations and repeat some basic concept, because I'm afraid to waste time, because it's not too much for the lecture. So let me open presentations and we discuss, because it's important to repeat these basic concepts. Let me open just a second. So I just open some selected slides in every presentation to put your attention, what to repeat, and also provide some comments. So first of all, let's start with the balance sheet. So this is the typical items and main elements of the balance sheet. Once again, balance sheet contains three basic elements: assets, liabilities, and common stock. So this is the list of items: cash, short investments, accounts receivable, notes receivable, inventory and supplies. This is what we also use as inventory. Prepaid expenses. It could be long-term investments as well. Equipment, buildings, and land we can call as a property, plant, and equipment. And also intangibles. So this is not the whole list. These are the typical items which you can find in the balance sheet of real companies. As for liabilities, as we right now discussed, this is the current topic for today: accounts payable or accrued expenses. Now you understand what does it mean. Notes payable, taxes payable. It could be also salaries payable, wages payable, interest payable. All liabilities, all payables should be included into this section. And finally, common stock retained earnings. And please remember that normally when we just treat the corporation, it should be additional paid-in capital, because in market economy, par value is not equal to market value. So this is the typical structure. Let me open. So here we have the format of the balance sheet, name of the 4 lines of heading. This is the cash, and what is the main accounting equation? Total assets are equal to total liabilities and stockholders' equity. So this is about balance sheet. Now let's consider our next statement, income statement. So there are two basic elements of the income statement: revenues and expenses. Revenues and income. I would like to add expenses and gain and losses. Revenues, income and gains, expenses and losses. So what are the typical examples? Sales revenue, fee revenue, interest revenue, rent revenue, and also we should add some other possible income. It could be interest income, dividend income. As for expenses, the list of examples or the list of items is the following: cost of goods sold, wages expense, rent expense, depreciation expense, insurance, repair, income tax expense, salaries expense. So this is the typical list. So let's see the structure. So the income statement can be prepared as a single step or multiple step. Normally we use multiple step approach. We should take sales revenue and subtract cost of goods sold, and then we calculate gross profit. After that we subtract selling, general, administrative expenses, and we calculate operating income. Then we subtract or add interest, income, or expense, and we get income before income taxes, then income tax expense, and finally net income. So I will repeat the structure of the income statement once again. This is the simplest format. Statement of stockholders' equity. Once again, what we discussed, common stock retained earnings, and when we calculate retained earnings at the end of the year, of the period, we should take beginning amount plus net income and minus dividends And finally, cash flow statement. There are three elements of the cash flow statements: cash flows from operating activities, cash flows from investing activities, cash flow from financing activities. And the statement of cash flows has three main sections. So cash flows from operating activities, cash flow from investing activities, and cash flows from financing activities. And if we observe the relationships between all these statements, you see, first of all, we should prepare income statement. What to do? Just to take all revenues, subtract all expenses to see the financial result of the business. So two possible outcomes: net income or net loss. After that, we should put this result to the statement of stockholders' equity in order to calculate ending retained earnings. And only after that we can prepare finally the balance sheet, because we should put into the balance sheet ending balance of retained earnings. So this is the structure of the balance sheet. And the last relationship on this slide between statement of cash flows and balance sheet. Look, ending cash in statement of cash flows should be the same amount as a cash on the balance sheet. And if you take the cash at the beginning of the year and at the end of the year, so it should be the same. And the difference is equal as a net cash flows from the statement of cash flows. So, dear students, what I recommend you to do when you start your preparations for the test one, please remember about this slide. Very good slide. This is the summary of all statements. So through 4 statements. This is the purpose. This is the description. What is important, the structure. So summarize structure and examples of content. So very good to repeat the material concerning statements. Right now, let me continue, and I will comment next moment about assumptions and principles. So maybe revenue recognition we just repeat later on, but Okay, so once again about balance sheet. This is the second topic too, second topic. So this is the classified balance sheet. This is the classified balance sheet. So all assets and all liabilities can be classified into two subtotals: current, non-current assets, current, non-current liabilities. So what is important to repeat about this second topic. This is the a new term as accounts. This is as a format used by companies to accumulate the effect of transaction. So this is, you see, separate files where we collect information about particular items. For example, we open an account, title it as a cash, and collect all information about cash. Or the same as for inventory. We collect information about inventory on this account. And all items have their own accounts. So we call these this list of accounts as a chart of accounts, the chart of accounts. Normally, a chart of accounts contains five parts or 5 blocks: asset accounts, liability accounts, stockholders' equity accounts, revenues and expense accounts, and revenue and expense accounts. So how to provide transaction analysis, This is a really important moment in all accounting course to understand the dual concept of accounting. There are two steps in transaction analysis. The first step is to ask the question, what was received and what was given In order to answer this question, first of all, we should identify the accounts by title, then classify them by type, assets, liabilities, or stockholders' equity, and finally determine the direction of effect, minus or plus, 2 possible directions, plus, minus. And finally, on the second step, we should verify that the accounting equation is in balance. So, dear students, in your test number 1, you will find questions concerning application of dual effect. What does it mean? You can have the task with a description of transaction, and then the question, what is the effect on assets, liabilities, stockholders' equity, increase or decrease? So, and all similar situations. So this is why it's important for you to understand the concept of accounting, how to treat at least on 2 accounts, and how to make records. So I don't want to repeat once again this transaction about issuance of stock we already discussed, but the approach is quite the same. For example, let's take these the purchase of property, plant, and equipment. The company purchased land, building, and other intangible assets, paid in cash, and signed a short-term notes payable. So here we see that we have increase in land, increase in building, increase in equipment, increase in intangible assets, decrease in cash, and increase in short-term notes payable. If we see on this horizontal model, you see decrease in cash, increase in property and equipment, increase in intangible, and increase in total payable. And finally, we can see that after this treatment, the accounting equation is in balance. So, and this is also, I recommend you as a slide to remember the main accounting equation in terms of debits and credits. So very good slide to remember how you should treat and how you should replace pluses and minuses for debits and credits. So this is debit plus, credit minus. And when you prepare accounting entries and put instead of pluses and minuses debits and credits, you can use this equation, this formula. Next moment to repeat the structure of accounting entry. Each accounting entry contains 3 components. First of all, reference, letter, or number, or date. Next and main component, this is the correspondence of accounts. So debit accounts and credit accounts. So debit accounts on top, please remember debited accounts on top, credited accounts on bottom. So this is what we should remember about the position of all accounts. And finally, it's of course, amounts, debited amounts on the left and credited amounts on the right. So dear students, this is the structure of accounting entry. And when you treat questions with entries, please remember that maybe you don't see the debit and credit, but you should understand that debited accounts on the top, credited accounts on the bottom, debited amounts on the left, credited amounts on the right. So this is the structure. Of course, in your test, you will find questions to calculate beginning balance, ending balance, some changes on debit side, on credit side, and it's important to understand the structure of accounts. So normally asset accounts have a beginning balance on debit, all increases on debit, all decreases on credit, and when we compute ending balance, we should take beginning balance plus debits and minus credits. For the owner's equity accounts and liability accounts, the situation is absolutely opposite. We have beginning balance on credit plus all credit minus all debits, and we get ending balance on credit. So this is you can see the format. For example, we have accounts payable beginning 600. The company had purchases on account, and the question is what is amount cash payments to suppliers, and we have ending balance. In order to compute, we provide these simple computations, and finally we get the answer that cash payments to suppliers is 1,800. So, well, this is all about T accounts. I recommend you to look through these T accounts because you find in your test number 1 questions concerning the structure of accounts and to compute ending balance. All these issues is trial balance. Trial balance, this is the list of all accounts with their debits and credits. So this is the listing of, normally the listing of ending balances in each account. So what is the purpose of trial balance? The purpose of trial balance is to make sure that the debits and credits are equal before we prepare the balance sheet. So you see total debits are equal to total credits. So what else do we have here? This is a balance sheet. Well, good. So let me open next topic, and we just look through the next topic. This is about operating cycle, very important material also. Let me repeat some selected pages. So first of all, let's repeat once again the structure of the operating cycle. Of course, begin operating cash to cash cycle. Please remember that operating cycle is a cash to cash cycle. We start with the cash. We purchase some goods or services on credit, then pay to suppliers, then sell goods to customers, then receive cash, and again open the new operating cycle. So it could be some specifications, for example, when we purchase goods, sell goods, and only after that pay to suppliers. But we just discuss the typical operating cycle. Please put attention, typical operating cycle. What else? Oh yes, here we have the description of main concept in accounting, which we call as accrual accounting. Accrual accounting. So the logic of this accrual accounting to consider time period assumption. Time period assumption, it means that we should recognize revenues and expenses which are devoted to the specific time, that to match them to each other. And we call it as accrual accounting. So let me just repeat once again the accrual accounting. I just would like to. So. There are two main approaches in accounting: cash accounting and accrual accounting. If we talk about cash accounting, on the cash basis, revenue is recorded when cash is received and expenses are recorded when cash is paid. But what is important, that IFRS and national standards of countries don't allow the cash basis of accounting. So this system is prohibited. We can use this system only for the specific taxation system and maybe for very small business. But in general, accounting standards don't allow the cash basis of accounting. So let me find accrual accounting. So accrual accounting. Accrual accounting has the following definition: assets, liabilities, revenues, and expenses should be recognized when the transaction that caused them occurs, not necessary when cash is paid or received. And in this case, we can consider three possible situations: cash received before the transaction, cash received in the moment of transaction, and cash received after the transaction. So, and in the topic 3, I recommend you to repeat the structure of entries, because in your test you find questions about revenue recognition, expense recognition. Please look through these entries, because you can find the same in your test. So this is all about recognition of revenues and expenses. And here you find the list of transactions, how to treat, what is the changes in assets, liabilities. Very, very nice presentation, very descriptive, very understandable. So I recommend you to open this presentation and to repeat the material So, well, let me open next one. Yeah, just 4 and 5. We are very close to the end. I'm happy that we repeat all the material. So the accounting cycle, this is about adjustments. So let me comment some selected slides about adjustments. So, the accounting cycle. So we can consider accounting cycle from the time criteria. So just what is going on during the accounting period and what is going on at the end of accounting period. During the period, accountants analyze transactions, make records, post amounts to the software or other accounting documents. But at the end of the period, we should prepare, as a company, on behalf of the company, the set of financial statements. In order to prepare financial statements, companies must follow the following steps. First of all, to prepare trial balance, to determine if debits equal credits. After that, to adjust revenues and expenses, and then to prepare a complete set of financial statements. And finally, to close temporary accounts as revenues, gains, and expenses to retain earnings. The main purpose of adjustments to adjust revenues and expenses to each other. So, dear students, I recommend you this slide first of all, because this is the summary of all typical types of adjustments. There are only 4 of them, not too much. Deferred revenues, accrued revenues, deferred expenses, and accrued expenses. So I don't want to repeat, because you already know this material. So also there are 3 steps in adjustment process. First of all, to understand what revenue or expense is incurred and is not yet recorded, what should we do? So also we should consider the effect of cash payment in the past or in the future. And also we should compute the amount. So 3 components. So what I can recommend, a summary of adjustment process, a very, very important slide. You see, this is the typical structure of every adjusted entry. So it's always the same composition of accounts of revenues and expenses. Please remember, revenues always on credit, expenses always on debit. And for each situation, deferred or accrued, you see the format of adjusting entry. So adjusting entries always have this following format. It does not depend what is the content of the transaction. So this is why I recommend this slide. this slide. So in this presentation also you can see how to treat and how to prepare adjusted entries. Very nice presentation with a lot of explanations. So, and now I would like to repeat that when you prepare income statement, you can compute some intermediate items like income from operations, income before income taxes, gross profit, so all of these. And post-closing trial balance, so this is the closing the accounts, so transfer net income or loss to retained earnings, establish a zero balance in each of temporary accounts. So once again, let me repeat that we should classify accounts into, let me see, where is it? Yes, here. So this is also a good slide where we have the classification of accounts as permanent and temporary. Please remember the temporary accounts always have a zero beginning balance at the beginning of each accounting period. And that means that at the end of the accounting period, these accounts should be closed to the permanent accounts. So in the balance sheet, for revenues and expenses, it's only one account, and this account has the title retained earnings, retained earnings. And finally, I would like to discuss, we have approximately about 12 minutes about current, non-current assets. It's important material. Let me open this. Lecture. Okay, so dear students, first of all, let me repeat once again and specify what is the definition of net sales revenue. So when we deliver goods or services as a company to the customers, it could be some special offers to the customers or special discounts. And we classify these discounts into three main categories: credit card discounts, sales discounts, sales returns, and allowances. And we should treat these discounts separately to allow management to monitor the situation in business. So, and in order to adjust sales for these discounts, we put them separately on specific accounts, and after that subtract from the amount of sales revenue, and we get the amount of net sales. Look, here we have 6,000 of gross sales revenue. Then we subtract these three possible discounts and we get the real actual net sales amount. This is why when you open the income statement, you always see the title net sales. Now you understand what does it mean net sales. This is gross sales adjusted by different possible discounts. So what is important, it's not a compulsory to have all these discounts. It depends on the nature of business. It could be or it could be not. So it depends. Also, we have the classification for receivables, accounts, notes, trade, non-trade, current, non-current, and I would like to repeat once again about bad debt expense and allowances for doubtful accounts. So, bad debt result from credit customers who will not pay the amount. So, it's a situation that we predict in the business that some of the customers will be not able to pay. And in order to match revenues and expenses in the moment of sale, we should recognize this possible bad debt expense as a reflection of the past experience. You see, it's not actual loss, it's not actual expense. This is expected expense in the future. But in order to match revenues and expenses in the current moment, we should recognize these expense as a special reserve for possible poor outcomes. And of course, it's a question how we should compute this reserve, how we should compute these estimated potential expense. It's not actual right now. We don't have any tools to measure it. No, only our estimations concerning future. So most businesses record an estimate of the bad debt expense with adjust an entry at the end of accounting period based on past experience, based on the market situation, on the reputation of the client. So in order to estimate, we should consider a lot of factors, and normally it's not the responsibility of the accountants. This is the responsibility of the managers. So, well, when we recognize bad debt expense, instead of decreasing accounts receivable account, we should open a special contra asset account with the title allowance for doubtful accounts. This is contra asset account. And this account is always the direct relationship with the accounts receivable. So, and once we recognize bad debt expense, we just put this amount for this specific account. But also it's a question where we should disclose information about debt expense in the income statement. Bad debt expense is normally classified as selling expenses. So this is what is important when you classify, when you calculate gross profit. You don't need to consider bad debt expense. But once you calculate operating income, then you should also consider bad debt expense. Please remember about it, because in your first test you can find questions concerning bad debt expense and the relationship with operating profit, operating income, and gross profit. So it's important to remember about it. So, what is important that if the company already created allowance for doubtful account, then in the moment of writing off specific and collectible accounts, instead of account from income statement, we use these allowance for doubtful accounts in correspondence with accounts receivable. So this is a very good slide, which I recommend you to take with you to the test number 1, because in your test you find questions concerning what is going on, what accounts affected, when we record estimated bad debt adjustments. So this is slide is really useful and very clear, and all summaries are prepared this. So what else? 2 methods of estimated bad debt expense. Of course, in your test you find these two methods. The first one, as a percentage of credit sale method, is really very simple. Just to take a loss rate, apply loss rate to credit sales, and to compute bad debt expense. So, and the second one, we use the aging of accounts receivable method. So we just take the schedule of accounts receivable and apply the estimated percentage and collectible rate. Then we calculate estimated amount and collectible. After that, we adjust if it's available for the with the balance or in allowances for doubtful accounts. And finally, we compute estimated bad debt expense. So on our seminars, we discuss this material. We already have done it yesterday on Monday with 3 groups, and on Friday we meet and again we discuss this material. So let me just comment briefly. So what time do we have? We have 3 minutes left, but let me maybe expand, because this was the technical problem and I missed some minutes, so maybe 5 if you don't mind. So if we talk about inventory, we should classify all businesses into 2 main categories: merchandisers and manufacturers, based on inventory approach. For merchandising companies, we use merchandise inventory account. For manufacturing companies, we should identify raw materials inventory, work in progress inventory, and finished goods inventory. So what I can recommend you also, this is a good slide to understand the flow of inventory costs, merchandise inventory, and then the cost of goods sold. If we talk about manufacturing company, raw materials, then work in progress, then finished goods, and finally cost of goods sold. So when we compute cost of goods sold, we should consider inventory flow. And in order to calculate ending inventory and cost of goods sold, first of all, we should calculate goods available for sale. Beginning inventory plus purchases, we get in goods available for sale, which contains ending inventory and inventory sold or cost of goods sold. So in this presentation, you find how to compute these cost of goods sold under three basic methods: FIFO, LIFO, and average cost. Please remember that currently LIFO method is prohibited under IFRS. LIFO is prohibited in Russian Federation. Of course, it's a reasonable question. Why should we learn about this method? So this method is not prohibited in some countries, for example, in United States, and we never know what will be in the future. Who knows? Maybe in the near future, LIFO will be not prohibited. So let's learn about computations of this method, because this method is existing method, but not is prohibited now. So here there are several slides about computing FIFO, LIFO, and weighted average. Good. So, and finally, I would like to comment evaluation of lower cost of market. So ending inventory is reported at the lower cost of market. Please read this material by yourself. We don't have any exercises in our practice, because the computation lower cost of market is really very simple. So what to do, just to calculate net realizable value as sales price less costs to sell. Please remember how to compute. And in order to evaluate, we should compare cost with net realizable value and to choose the lowest. For example, in this case, we have Intel chips and disk drives. We compare. In first case, we take a net realizable value. In the next, we take cost, compute the total, and then adjust. Please remember that the adjustment for these holding loss should be calculated based on the all assets, all items in inventory, and then finally we put this amount on the cost of goods sold. So what else do we have here? So right, and finally, briefly about property, plant, and equipment. So dear students, what I suggest you to do, first of all, to understand what is the structure of acquisition cost. What should we include in the acquisition cost? It's not only purchase price, it's also some direct costs. So because in your test you find questions about computing acquisition cost. Also, this is how to treat acquisition of fixed assets. Also repairs, maintenance, and improvements. So please remember that we should divide all expenditures by two types: ordinary repairs and improvements, and just to treat differently. So all improvements must be added to asset account to be capitalized. Ordinary repairs must be treated as a periodic expenses. So this is also what I recommend you, this slide. This slide helps you to solve questions which are devoted to repair and improvements. And finally, depreciation concept, very good slide, just to understand where we should put depreciation expense to income statement, accumulated depreciation to the balance sheet. And I would like to say that in our this is how to prepare just an entry for depreciation. And also I would like to say that in our course we just discuss only straight line method of depreciation. In the textbook you will find units of production and accelerated methods. So because of the shortage of our course, I decided to skip this material. We will learn in our intermediate course. For this course, only straight line method. Please read only this material, how to compute straight line depreciation. And here in your presentation, you find the units of production and decline and balance method. So if you don't want to learn much more in accounting, you can skip these slides. It's not compulsory. This is some kind of supplementary readings in our course. So, well, I think that maybe it's all for the fixed assets, depreciation computation, and finally disposal of property, plant, and equipment. So also it's important to understand how to treat disposal and tangible assets. This is the classification. Some concepts about amortization of intangible assets. We should identify intangible assets as the assets with definite or indefinite life. Is it definite life? It should be amortized like property, plant, and equipment. Absolutely the same approach. If it's not amortized, it should be tested at least annually for possible impairment. So, well, so dear students, that's all briefly. We just repeat all the material. Once again, I would like to say that you have your test next week, test number 1, in our ordinary schedule at the seminar time. So 3 groups will write the test on Monday, 3 groups on Friday. So important dates, 11th of October and 15th of October. Please put in your schedule that you should be in the class to write the test. And other specific rules and recommendations I will put into the system, and you will receive an email about this test. And also you will find all these rules before the test when you open. The only my also request, please come into the class in advance, 5 minutes, at least 5 minutes, it's better to 10, to be prepared, because the duration of the test is 80 minutes. And in order to start and to finish properly, we cannot spend time for preparation. So it's better to do it in advance. Well, dear students, thank you very much for your attention. Thank you very much for this great opportunity to stay with you during our lectures and seminars. And I hope we meet in December for the business game. It will be very interesting business game. So it's not the, please remember, it's not the end of our course. It's only the end of the first part, financial accounting part. So in the second module, you will have another instructor for the second module, Yurina Shirokova, my colleague. And at the end, at December, we meet again, we play the business game, and then finalize with your grades. But I would like to say that after the first test, I will put your percentage grade for the first test to the LMS system, and you can see your progress, as well as in class participation for financial accounting part. So this is about your grades for the in-class participation in financial accounting part, and also your results in the test number 1. So, but anyway, we discuss all these questions and all other issues concerning the test and grades a lot. So to be clear everything for you. So dear students, thank you very much for your attention. Do you have any questions?